Hi, welcome back. Silver just ripped through $60 an ounce in a matter of days, and then, almost as fast as it climbed, it turned around and gave back a huge chunk of that move. And here's the strange part. The reason has almost nothing to do with silver itself. By the end of this video, you're going to understand exactly why $62 and $58 are the two numbers every single silver holder is watching right now, and why bond traders on the other side of the planet just had more influence over your metal than any mine, any mint, or any jewelry demand report. If you own silver, if you're thinking about buying silver, or if you simply have a retirement account sitting in the market right now, this affects you more directly than you might think. Because what moved silver this week is the same force that quietly moves your mortgage rate, your savings account yield, and the value of every dollar sitting in your bank. Let's set the scene. Bond yields around the world spiked hard, not just in the United States, but across Japan, the UK, and parts of Europe at the same time. When yields spike like that, all at once, across multiple countries, it tells you something bigger is happening underneath the surface than a single central bank decision. It signals that global investors are demanding more compensation to hold government debt, and that shift ripples into every other asset on the planet, precious metals included. So while the headlines were busy explaining silver's pullback with silver-specific reasons, industrial demand here, a mining update there, the real story was happening in a completely different market, one most people never even watch, and it happened fast. Bond markets don't usually move this quickly outside of a genuine shock. Traders who track sovereign debt for a living were describing the move as one of the sharper multi-country yield spikes in recent memory, the kind that forces every other asset class to reprice almost overnight, whether or not that asset had anything to do with bonds in the first place. Precious metals traders watched their screens, and within hours, silver was giving back gains that had taken weeks to build. Here's what this actually means for you. When yields rise sharply, it becomes more expensive to borrow money, whether that's a government, a corporation, or you personally through a credit card or a car loan. That has a chain reaction. Investors who were holding non-yielding assets, and silver pays you no interest just for holding it, suddenly have a more attractive alternative sitting right in front of them. Why hold an ounce of metal that generates zero income when a government bond is now paying you a real rising return? That single question is what triggered a wave of selling across precious metals, and silver, being smaller and more thinly traded than gold, felt it even harder. Now this is the part that matters. Silver is not just a monetary metal, it's also an industrial one used in solar panels, electronics, and electric vehicles. That dual identity usually helps silver in a growing economy. But when bond yields spike because of fear, not growth, that dual identity works against it. Investors start pricing in the possibility of slower economic activity ahead, which threatens the industrial side of silver demand at the exact same time that rising yields are hurting its monetary appeal. Silver got squeezed from both directions simultaneously, and that's part of why the pullback felt sharper than it did in gold. Think about it this way. Imagine you're deciding between parking your savings in a safe that pays you nothing or a bank account that suddenly starts paying you 5% interest. If that bank account rate keeps climbing, more and more people will move their money out of the safe. That's roughly what's happening between bonds and precious metals right now. The safe is silver. The bank account is government debt, and when the bank account interest rate jumps fast enough, some money moves, even if the people moving it still believe the safe holds something valuable long term. But here's the part most people are missing entirely. This isn't really a story about silver losing value. It's a story about the world recalibrating how much it trusts government debt. When yields spike this aggressively across multiple major economies at once, it often reflects growing concern about government deficits, debt sustainability, and whether central banks can keep inflation under control while managing enormous debt loads. That concern doesn't just evaporate, it tends to resurface, and when it does, it has historically pushed investors right back toward hard assets like gold and silver, because those assets don't carry counterparty risk the way a bond does. A bond is a promise from a government to pay you back. Silver is just silver. So what does that tell us? It tells us this pullback may be less about silver's fundamentals breaking down and more about a short-term repricing of risk appetite across the entire financial system. And that distinction matters enormously for how you interpret what happens next. If you're managing your own savings or a retirement account, this is exactly the kind of moment where the headlines feel alarming, but the underlying picture is far more nuanced than a single week's price chart suggests. Now, before we go further, if this kind of breakdown is helpful, hitting subscribe means you won't miss the next video where we walk through what happens if yields keep climbing from here. Let's get back to it, because there's a piece of this most coverage completely skipped. Central banks around the world have been buying gold at a record pace for several years now, a trend that has continued even through periods of rising yields. That's unusual. Historically, higher yields made gold less attractive to central banks too, because gold, like silver, pays no interest. But central banks have kept buying anyway, which tells you they're not making this decision based on short-term yield math. They're making it based on long-term concerns about currency stability and diversification away from any single reserve asset. Silver doesn't get the same central bank buying that gold does, but it does tend to follow gold's broader trend over time, which is part of why many analysts watch the gold-silver ratio as a signal for where silver might be headed relative to its historical relationship with gold. There's also the industrial demand thread we mentioned earlier, and it deserves a closer look. Solar panel manufacturing, electric vehicle production, and expanding electronics and AI-related infrastructure have all been steadily increasing the amount of silver the world actually consumes each year, separate from any investment demand at all. That physical industrial appetite for silver hasn't disappeared, because bond yields spiked. Factories still need the silver they need. What changes in moments like this is investor perception of where the economy is heading, not the physical reality of how much silver gets used in a solar farm or a circuit board. It's worth separating those two things clearly, because headlines often blur them together as if a price pullback proves demand is falling, when frequently it doesn't. Here's where it gets interesting. This is where those two numbers come back in. $62 represents a level analysts have flagged as a zone where silver previously struggled to hold its footing, a spot where sellers have stepped in before. $58 sits below the recent breakout zone, an area some traders are watching as a level where buyers could plausibly step back in if the pullback continues. Neither number is a prediction. Nobody, including any professional trader, actually knows with certainty where silver goes from here. But these are the zones the market itself has been reacting to, and watching how price behaves around them can tell you a lot about whether this is a healthy pause in a longer uptrend or the start of something more prolonged. Let's break this down with an analogy that might make this click. Picture a hiker who just climbed a very steep hill quickly. At some point, even if the hiker plans to keep climbing, they need to stop, catch their breath, maybe backtrack a little to find better footing. That pause doesn't mean the hiker gave up on reaching the top. It means the climb got steep enough that a breather became necessary before continuing. Silver's move from the low 30s to over $60 happened remarkably fast by historical standards. A pullback after a run like that isn't unusual, it's almost expected. The real question isn't whether silver paused. It's whether the hiker is catching their breath or turning around entirely, and that's something only time, not any single week of price action, can answer. Now let's be honest about the other side of this, because acknowledging the risk here actually matters more than pretending everything points in one clean direction. If bond yields continue rising because inflation proves more stubborn than expected, or because government debt concerns intensify, that could keep pressure on precious metals for longer than some expect. It's also possible that if yields keep climbing, central banks are forced to respond with policies that could either support metals over the medium term or create additional short-term volatility depending on how markets interpret those moves. There's no guaranteed outcome here, and anyone telling you they know exactly what happens next in either direction is skipping over just how unpredictable these markets can be. Rising yields could persist. Inflation data could surprise in either direction. Geopolitical developments could shift sentiment overnight. None of these are things any script, including this one, can forecast with confidence. What you can do is build a simple framework for thinking about moments like this, one you can reuse well beyond this particular pullback. Ask yourself 3 questions whenever a sharp move happens in any asset you hold. First, is the move driven by something specific to that asset, or by a broader shift happening across markets? Second, has the underlying reason you originally held that asset actually changed, or is this a reaction to short-term positioning and sentiment? Third, what would need to happen for your original thesis to actually be proven wrong versus simply tested? Silver's pullback here traces back to a broad multi-country bond yield spike, not to anything specific breaking in the silver market itself. That doesn't mean the pullback isn't real or that it can't continue. It means the reason behind it is different from, say, a mining company reporting a massive new supply discovery that changes the fundamental supply picture. So here's the loop we opened at the very start, finally resolved. $62 and $58 aren't magic numbers with some hidden meaning. They're simply the visible battle lines in a much bigger fight happening in the bond market, a fight over how much risk investors are willing to accept in exchange for holding government debt. Silver is caught in the middle of that fight, not because anything is wrong with silver, but because it sits at the intersection of monetary policy, industrial demand, and investor psychology all at once. Watching those 2 levels won't tell you the future, but it will tell you in real time which side of that bigger fight is currently winning. Now, connecting this back to your own money for a moment. If you hold any precious metals, or you're considering adding them to a broader portfolio, moments like this are less about panic and more about perspective. A pullback driven by a global yield spike is a fundamentally different event than a pullback driven by, say, a collapse in industrial demand or a major new discovery flooding the market with supply. Neither should be reacted to emotionally in the moment, and neither should be ignored either. The healthiest approach tends to be understanding why a move happened before deciding what, if anything, it means for your own plan. Looking ahead, a few things are worth watching closely over the coming weeks. Central bank commentary out of the major economies will likely give hints about whether this yield spike is viewed as temporary or as the start of a longer trend. Inflation data releases will matter enormously because sticky inflation numbers tend to keep yields elevated, while cooling inflation could ease some of the pressure we just walked through. And gold's behavior relative to silver, that gold-silver ratio we touched on earlier, will be worth tracking as a signal for whether metals broadly are stabilizing or whether more volatility could be ahead. To bring this together, what looked like a silver-specific crash was really a bond market story wearing a silver-shaped mask. Yields spiked globally, non-yielding assets got less attractive overnight, and silver, sitting at the intersection of monetary and industrial demand, absorbed more of that shock than most people expected. That doesn't erase the reasons silver rallied in the first place, and it doesn't guarantee where price goes from here either. What it does give you is a clearer lens for reading the next headline that tries to explain a metals move using only metal-specific reasons, when the real answer might be sitting in a completely different chart entirely. There's actually a bigger question building underneath all of this that we haven't even touched on yet. One involving how much government debt is coming due over the next 12 months across the world's largest economies, and what that could mean for yields long after this particular spike settles down. That's a much bigger story, and it's exactly what we're breaking down next, so keep an eye out for that one. Thanks for watching, and I'll see you in the next video.